Joins us now, John. Where to begin? You know, I said yesterday, this is my vision, that Jagmeet Singh, Pierre Poilievre and Mark Carney appear on a stage together and say, whatever our differences, we're all heading for Canada.
Yeah, and I mean, how do you react? I mean, it's sort of irrational what's coming in from the other side of the border. So how do you react in that environment? So, you know, you can't really turn off the noise because you have to, take it into account on an investing basis. So that's, my decision. I'm a trader. I got to figure out what we're doing for our clients and what we're doing in the markets, Andy. And that's sort of, the strategy right now. I went into this year cautious, and there were three things that bothered me about the stock market: valuations, sentiment, and positioning. We've corrected one of those in the past month. I mean, I think you've corrected that overly bullish sentiment, which is
south of the border anyway.
Overall, it's actually, because of what's been going on. So that helps, but that's not enough. And in fact, positioning is still very positive, very bullish right now. When you look at, where hedge funds are, where quant funds are, where the public is over 70%, which is why you sort of see, I'd be curious to see the market opened up this morning. How does it close at the end of the day? Because you're still, people are selling into the rallies rather than buying the dip. So I think that's a risk going forward. So, I don't think that's about to change. And still an expensive market, even though stocks have come down. You're still 21 times forward earnings in the U.S. So, it's not cheap. And like I say, positioning is a risk. Sentiment's got a little bit better. So you might get a trading bounce at some point. But, the market will give you opportunities. And we're looking around. What's getting beaten up? Where does it make logical sense to do some buying and put some of our cash to work? I mean, I look at a name like Celestica, was trading up north of 190. Suddenly we're buying it down to 110.
CLS in Toronto, yeah.
Yeah, and nothing has changed in terms of the story for data centers and the build out and where they're positioned. In fact, they're beating their earnings. Capital Power, another one, the electricity story. So the market will give you these opportunities to buy things. I think the other important thing about these tariffs, we were buying Algoma Steel yesterday and some of those names, which seems, why would you do something that ridiculous? I don't think in the end what Trump is trying to do is going to be achievable, of sort of reorienting sort of U.S. business entirely. I think the problem is that capital decisions are made for long periods of time. You spent 4 decades putting this supply chain in place, in North American supply chain, building it, putting it in place, getting dynamics of it. They're not going to unwind it in a hurry. They'll do some token moves, but capital expenditures, they need to know what's going to be happening for the next, 10 or 15 plus years.
Or longer even,
yeah. What everybody knows is that this guy's not going to be president in 4 years, and whether it's, a Democrat or Republican, it doesn't really matter. They're not going to make big policy changes, big capital expenditures in that environment. So, when someone comes on and says we're going to eradicate, the Canadian steel industry or the Canadian auto industry or whatever, it's not going to happen. Ultimately, we'll take some pain, but the stocks are already reflecting that. So where you can get the worst case scenarios built in and you can buy these things a little bit cheaper, I'll go out and buy them. And like I say, the market has driven so many things down recently, and we take the opportunity. We're still, underweight stocks. I'm still, we got rid of all our high-value stocks, the high-value tech stock, the cyber stocks. Those things are most at risk. And, economically sensitive stocks are somewhat at risk still, but the market gives you opportunities. And remember, people like myself, I probably drive my trader crazy lately. It's an active market, and I think it'll give you opportunities to add. We're still sticking with U.S. bonds for now. They haven't defaulted on their debt yet, so something like 4.6, 4.7 for long-term U.S. bonds. It's still a nice hedge in the portfolio. It's acted well, I think, to protect the values, and we'll just continue on. But it's a time to be cautious. Economy slowing down, rates are coming down. That's a bit of a warning flag.